Welcome to Far From Wall Street. This is Michael McCall for the week ending Friday, February 2nd, 2017. First, some perspective. The S&P 500 surged 40% since Donald Trump was elected. Last week, the market gave back 4%. So let's take a step back. If you had the power of perfect knowledge, the power to predict which one of 12 types of investments representing a wide range of assets was going to be number one every year for each of the 15 years from 2002 through 2016, you would have averaged 29.9%. Of course, no one has the power to predict which investments will be number one every year. Surprisingly, accepting that and instead maintaining equally weighted positions in the 12 types of investments, you would have averaged 7.5% annual returns with significantly less volatility, making it much easier to stomach the current downturns. To be clear, to average that 29.9% return every year for 15 years, you'd have had to invest 100% of your portfolio in commodities on January 1st in 2002 and held it until the end of the year, and then in the emerging markets on January 1st, 2003. And you would have had done that again and again every year through 2016. The yellow boxes highlight the number one asset classes in each of those 15 years. It's obviously totally unrealistic to expect this. It would take a miracle to pull this off. But what is perhaps more miraculous is that managing investments in the same time period based on a quantitative discipline and understanding of the history of investing and rebalancing annually achieved an annualized total return of 7.5%. Yes, less of the highs, of course, but also more importantly, less of the lows. This way of investing is part of a large body of academic research developed over the past 70 years, generally called modern portfolio theory. It's an approach I believe has merit, and it is very different from trying to predict the future and pick which investment will be number one next year. A daunting task. The lesson here is that you do not need perfect knowledge to weather these financial storms, which will always occur, and succeed financially in life. Sticking with a plan for the long term that is not based on miracles, but rather on moderation, may be enough to pay for all you need in life, regardless of when these market corrections happen. Withdrawing money from leading investments and deploying it in lagging types of assets to reset a portfolio back to equilibrium at the end of every year helped lower the risk of this portfolio, and the 7.5% average annual return may be enough to enable financial success. It's counterintuitive, but those are the facts. Of course, past performance is not a guarantee of your future results, nor is a quantitatively driven discipline. But it may be able to give you enough to succeed, and it's a sensible long-term plan that helps make current markets easier to deal with. Remember, investing is not the same as trading. With stocks appreciating sharply in 2017 and early 2018, only to drop on Friday, be sure you are rebalancing properly. You can call on my office for prudent portfolio management based on economic fundamentals and quantitative analysis, or with any questions about your portfolio. Please contact my office with any questions or to set up a meeting. And don't hesitate to share this video with friends who might benefit from my work. Remember, especially in times like this, it's great to be far from Wall Street.